Thank you very much for giving me the opportunity to come along to talk to you today. It's a very good time to be talking because we've had the worries about Brexit, we've had the fact that a lot of share prices, particularly the smaller end of the market, haven't performed over the last 18 months. And we've got quite a big change coming through in terms of the political leadership and most particularly the prospect for economic policy changing going forward. Although I've written books before, and I've just published this new book called The Retreat of Globalisation, I don't normally set out to write books. That's certainly not my main job. I'm here to make money for clients. I'm here to talk to clients and explain to them why we're positioned as we are. But one of the things is when things are changing, it's really helpful for me anyway to set things down on paper. Because when I look at them and read them afterwards, I feel that sometimes they don't always say quite what I mean. And that process of sort of changing it so it means what I want it to say is a process which helps me to clarify my thoughts. And the second element of going around and checking the evidence which I'm citing to back my arguments and find whether it's actually valid or whether it's slightly different to what I remember is another process which actually ensures that actually at the end of the day I get to a conclusion which I think is relatively robust. And so over the last sort of 6 months particularly, I have been thinking about the changing attitudes of the electorate, and most particularly about how that might feed through to recent election results, Brexit and Trump, and possibly some in Europe in the coming year, but also about how that will feed through to economic policy. Let's just remind ourselves, going back over the last 30 years, it's been entirely politically consensual, whether left or right, to embrace globalisation. And now we've got to a stage where some of the electorate anyway, are not certain what they want, but what they are certain is that they don't want the status quo. And so we're getting to a period where there's a change in social attitudes leading to a change in political attitudes, and that's beginning to lead to a change in economic policy. And the conclusion of the book, and I'll talk a little bit about the implications, is that actually there'll be more change in economic policy in the next 3 years than we've seen for the last 30. And if that is the case, then us as investors collectively, we will have to steer through what is a period of change that will throw up opportunities, but it'll also present lots of challenges. And if we can think ahead and hopefully spot some of the challenges and hopefully pick up on some of the inefficiencies and the opportunities, then perhaps we can do well for our clients through the process. So with that in mind, I wanted just to kind of go back and just talk a little bit about the pattern which we've seen probably in the last 30 years. Property sector's done very well, many other sectors done very well. This is a pattern looking back at bond yields, 10-year bond yields in the UK. Certainly back in the sort of early 80s and mid 80s, you could have got 10% yields on bonds, on gilts, government debt. And then that came in pretty hard actually as globalisation started. The import of international goods, particularly Chinese and other low-cost goods, meant that actually although there was inflation within the UK system, it was overwhelmed and offset by imports. And imports came in at lower and lower levels. Inflation didn't take off despite economic growth, and that led to bond yields coming down. We had a long period of stability in the 2000s. That was a period when there was some inflation, but not much. Economic growth was strong. Leverage was strong, of course. Lots of companies did very well. Lots of economic growth was plentiful. And that only came to an end when we had too much leverage and the inefficiency of allocation of capital, which led to things boiling over, as we know, Lehman's going bust. But most particularly, the adoption of quantitative easing and interest rate cuts. In the whole of the period since Bank of England was first set up in the 1600s, interest rates in the UK had never previously fallen below 2%. So we'd had world wars, we'd had Napoleonic wars, we'd had depressions and recessions and all the other things which we had along the way, high unemployment. Interest rates previous to 2008 had never fallen below 2%. Anyway, they were cut to 0.5%, and as you know, they're at 0.25% now. So initially, the reaction was that led to lots of inflation. People were very apprehensive. They thought it might be a short-term fix, but actually inflation hasn't taken off. Not so much because we've had imported goods which are coming through. They certainly have continued, but most particularly because world growth has slowed more recently. And when we saw that wobble in Europe with the question of whether Greece would come out of the euro and perhaps some of the European banks would go bust, at that stage, people realised that actually the interest rates were likely to stay lower for longer. And at that stage, you can see that second stage of bond yield compression happened. And that's really been most specific or most evident in the last 5 years when bond yields have moved from low levels to ultra low levels. And as you know, bond yields, not just in the UK, but around many of the developed markets, are on very, very low levels indeed. The effect of that has been that all other assets have looked cheap, not just property assets, not just equities or other bonds and such like. But what you've seen is actually a period when world growth has been relatively disappointing, not much world growth. Certainly we've seen the slowdown or wobbles in China, which have led to the commodity prices collapsing, oil prices collapsed, many of the commodity prices collapsed, they've bounced from the bottom now. Alongside that, we've also seen various margin pressure, certain things like the supermarkets and such like have had price wars. And so overall earnings growth hasn't been very good across the economy in the last 5 years, but what you have seen is that actually the market's done very well. And that's not down to earnings growth, that's principally down to valuation change. So on a prospective basis, in the middle of the Greek crisis, you could have bought the FTSE 100 on a forward-looking P ratio of about 9 times. A lot of people didn't believe it at the time, but it's sustained. But most particularly, although earnings growth hasn't been very good over the last 5 years, share price has gone up because now the forward-looking PE ratio is at 16 or 17. That's excellent for anyone who's been making money on index funds and such like in recent months and years. But most particularly, it's not the long-term way to make money. If you want to make money long-term, as Ben was saying, you have to buy something with an income and see that income grow. So from the point of view of looking under the bonnet here, actually valuations, if you look over the 50-year period, sometimes high and sometimes low. It's a long channel. So they may be a bit higher at their end currently. They may go even higher. I'm not saying they won't. But what I do know is that over the next 10 and 20 years, they won't go out of the channels. So the valuations of the market will be higher and lower at different times. But you won't make money just by hoping the valuations move up. You make money by buying good and growing assets with yields. And so if we look under the bonnet at what's happened to the Allshare in terms of income in the Allshare is just under 4% or so. It's a nice yield. Most particularly, if you held Allshare index last year, for example, you would have enjoyed an income growth of around 4.2%. So if you've got an asset which is yielding around 4, if it grows its income, say on average for 4.2% forevermore, assuming the valuation never changes, it's always in that channel, then effectively you get about a 4.2% growth in capital. That's the income growth. Along with your income you're already getting 4%, you get an 8.2% return. That's a very handy return when inflation is very low. So under the bonnet, it looks as though actually markets were pretty good last year. In fact, valuations narrowed a bit and we had higher valuations at the end of the year than the beginning. So overall investment returns were well over 8% last year. But the pattern looks as though it's looking pretty good. Small companies, I mentioned at the beginning, haven't really had a lot of attention. What we had with the re-election of the Conservative government was the prospect of a Brexit vote. We all knew it was coming up. Institutional investors all knew it was coming up. And so generally what's happened in the last 18 months, 2 years particularly, is that although in the run-up to Brexit, there was some anxiety about Brexit. Assets were withdrawn from the UK, both big and small, but particularly small because people felt that they were uncertain about domestic assets. And since we've had the referendum result, the last 6 months, the main market has actually picked up very substantially. The devaluation of sterling has meant that the assets look cheap. Also, some of these companies have overseas earnings and particularly overseas dividends, and therefore we've seen the market do pretty well. And a lot of institutional investors are called flat-footed, too much cash, not enough assets in equities, have chased their tail. They have put some more equity, some more allocations into equity, but most particularly heavily into mid and large caps. Small companies, we still don't know how Brexit's going to unwind. We don't know whether the economy will slow in the future. We don't know whether it'll be a hard or a soft Brexit. And so generally, although small companies have continued to grow pretty well in the second half of last year, what we have seen is that's really done largely without much capital appreciation. So share prices and PE ratios have actually gone down in small companies over the last 18 months and 2 years, whereas across the mainstream market, they've actually gone up. And so we've had a valuation gap building up between the two, which we think could be quite interesting going forward. But looking back again at where we're going to go from here, on the 30-year view, this period when we've had this consensus in economic policy, we've got to a stage really now where the bond yields are pretty much as low as they can go. That's not to say that UK bond yields can't go back down to 0.5% on the 10-year basis. They certainly can, and maybe they're going on there right now. It is even possible that on a sort of future basis, in certain circumstances, the bond yields in the UK could actually move negative, as they did in Germany, -0.5%, even -1%. But what we do know is they've come down from over 10 to around 1.5, possibly 1 or even a half. And we can say going forward that the long-term trend of falling bond yields is coming to an end. And indeed, you can see here that bond yields actually bottomed in July or August last year. That may have been the ultimate bottom. We'll never know for another 5 years or something. But what we do know is it's somewhere near the bottom, and it may have passed the bottom already. So fundamentally, the trend which has been driving valuations up, the trend which has been driving asset performance, particularly on equities, but also other assets as well, has been coming to an end. And going forward, many of the institutional fund managers who've got very used to this trend are going to have to start to learn new tricks and new methods of making money, because just doing the same thing as we've been doing for the last 10 and 20 years won't be good enough. And most particularly, if we look at the underlying dividend growth across the Allshare index, for example, last year, it was really all about the devaluation of sterling. As you know, Shell pays its dividend in US dollars. It's a US dollar company in that regard. It buys and sells its goods in US dollars. And so the devaluation of sterling meant that the business itself was actually worth 10, possibly 15% more in sterling terms. But in terms of the income paid by Shell, it didn't have the oil price recovered, the underlying business wasn't a lot stronger than it was the previous year, but most particularly the income stream was another 15% higher at the end of the year than it was at the beginning of the year. And because of that, obviously we got lots of income growth last year in the Allshare. But if you net off the fact that the income growth was down to the devaluation of sterling, if you net off the devaluation currency effect, then actually if you look at the whole of the Allshare last year, dividend growth was -1%. So it's all very well getting an asset, a yield, but if you don't get dividend growth, then you're not going to get a long-term capital appreciation. And certainly if we see ongoing dividend cuts going forward, and dividend yields are under pressure at the moment, and we've seen cuts from people like Pearson and others, then from that point of view, we could be under pressure. And one of the ways of measuring that is to look at dividend cover. Dividend cover is a measure of safety, of how secure that dividends are. And if you look at dividend cover, this is the last 20 years. A high level means lots of dividend cover and safety. A low level means low dividend cover and not much safety. And this is based upon earnings, not even cash generated. And a lot of companies generate a lot less cash than they do report in terms of earnings. And what you can see there is, although 2008 there was a wobble, world growth was very low, the introduction of QE for the first time, the move towards governments running a budget deficit rather than budget surplus. Interest rates being cut from 5.75%, let's just remind ourselves, 5.75%, which is what they were before 2008, down to just 0.5%, 0.25% now. These policies, along with the investment of infrastructure in China, were very positive for the recovery of the world economy. It grew very strongly, as you know. There was a real recovery. You can see here the surge in terms of dividend cover came through very substantially. But since 2012, effectively, we've seen world growth stagnate. It is still going forward, but it's very slow now. And most particularly, there's not much top-line growth. There's not much expansion of margins. And for that reason, dividend cover, companies have continued to grow their dividends, has been done at the expense of safety margins. And we've got to a stage now where companies, when they disappoint, it's not a case of whether they can sustain their dividends. Usually, they are forced to cut their dividends. So we may see more dividend cuts coming for, certainly if there was a big economic setback in the US or around the world, then there was room for more dividend cuts, and thereby share prices may be under pressure. So what about the prospects going forward? I've talked a little bit that we've been in a very exciting period where economic policy has been very consensual. But what's interesting is this is a outlook, well, current position, in fact, for world productivity. And world productivity is the cornerstone of all investment return. What happens is when we take savings and allocate it to individual companies, the opportunity is that those companies put that cash to work in productivity improvement and generate a cash payback which exceeds the value of the original capital allocation. And that's the cornerstone of all investment returns. And what's been amazing, not so much recently, but even since 2008, is although there was a short recovery period in 2009 and 10, since 2011, effectively, we've seen productivity flatlining and indeed slightly decreasing, even though we're not in a world recession. This is very unusual. And it's extremely worrying for the long term. We won't be making good returns on our equities unless we invest in productive companies. And currently, for all sorts of reasons, we don't seem to be allocating to the most productive companies. Certainly, if you buy an index fund, you are allocating 8% of your capital to Shell. And whilst Shell might be a good company, it might be investing in the long term and all the rest of it, it's not as productive as many of the smaller, more nimble companies. And at the moment, unless the oil price moves to 60 or 70, many of those investment decisions made over the last 5 and 10 years won't justify the IRRs and the long-term cash paybacks which were made, which were assumed at the time of the investment. So what we've got to do is move towards actually being much more deliberate about selecting our companies, not investing in indices, not investing in ETFs, but actually moving back to the old-fashioned skill of finding individual companies which can put cash to work to generate cash paybacks. We've got to be a lot more discriminating. And certainly our view is that as we get economic policy changing going forward, we're going to find there's going to be a lot more disappointments, and companies which do get caught out are more likely to suffer and could go bust. We haven't seen many companies going bust in the last 15 and 20 years. And most particularly, that will throw up the opportunities for those companies which are nimble and able to take advantage of the weakness of others to improve their position. So there'll be more opportunities to select between the winners and losers going forward. Active stock selection, in our view, is going to be much more important going forward than it has been in the past. It's not just, though, in case of meeting companies and asking them what their investment plans, whether they're buying some IT or putting some money into a new sales force or even capex, as it is here. It's actually, you've got to find the cash payback on that. What we've got here is some charts showing the global capex across different sectors, and this big blue sector here, which is the majority of world capex, or the largest part of world capex, is the energy sector. So back in 2013, about 31%, nearly a third of all world capex was going to the oil sector. And that's good because we do need energy, and energy is the cornerstone of all economic activity. But a lot of those assumptions were making the assumption that oil price would be $80 for the next 15 or 20 years. And of course, that was an assumption which wasn't correct. And the problem with a lot of those investments is they are made on a 10-year basis. And because they're making them on a 10-year basis, they find that actually the assumptions they make are not correct. And so what we've seen since 2013 is that only a quarter of capex, world capex, is going to the energy sector now. So we've seen a big cutback in that area, and that's led to many companies struggling to actually get the returns they were originally expected. And certainly if you make assumptions over 10 years, you only have to look over the last 10 years to recognize that the assumptions can be wrong, and they can be very, very wrong. So when you're selecting individual companies, one of the opportunities is not just to select companies which are investing for cash paybacks, but most particularly for cash paybacks over relatively short periods. We would recommend looking for companies which actually have the ability to generate a cash payback relatively quickly, because then if things change, they change after the cash payback's already been received. So many of the companies which are slow cash paybacks, we would say, are more, you have to be more worried because you have to make assumptions which may or may not be valid. What you can also see here is a couple of slightly lighter spots here. So this here, this little tiny yellow patch here, is the capex which has been going into pharmaceuticals and medical developments. I think it's very interesting to see how it compares with the energy sector. You think the valuations of many of the medical companies around the world, you think that the cash payback they're getting on this is very high. One wonders about that. The other one, this other one up here, is the IT sector, Apple and all that lot. Again, these companies are not investing as much as you might think, generating very attractive cash payback. So again, be careful in those two sectors. And going forward, what we're quite excited about is that actually, because there's an economic policy change coming through, we may find that actually the market is caught out. Certainly, it's easy and consensual for most investors to worry about the fact that actually we're seeing a rise in import costs, inflation is rising, wages may not rise that much in the next few months, and on that basis, most people are assuming there will be a consumer squeeze. That may be the case, but we're not certain about that. But what we can say is the banking sector generally has moved to a position now where it's actually entirely fixed. All the legacy issues largely about the global financial crisis are behind it in the UK position. And if anything, banking borrowings in the UK have been rising quite quickly recently, particularly to the corporate sector, but also to the consumer sector. And it may be the consumer can continue to borrow faster to get through this period of wage squeeze, and that might mean that the UK economy could surprise, not just in sustaining growth as it has over the last 6 months, but actually over the next 12 or 18 months could continue to be one of the best growing economies in the world. And certainly if that is the case, there's a lot of institutional investors who are going to get completely caught out by the fact that small companies will start to outperform larger companies. Certainly over the last 12 months, if you look at the Allshare, total Allshare dividend growth was -1%. If you look at many of the small companies at the bottom end, if you look at them in aggregate generally, you find that dividend growth across the smaller end of the market has been sustained and well above that of the main market. And that is a fundamental which is going to drive performance, certainly if the UK economy continues to grow. So we all have to worry about what's going to happen in 2 or 3 years when Brexit comes through. We have a lot of uncertainty about it, but just right now, it may be the UK economy surprises on the upside. And what's interesting about that is the market seems to be already sensing it. Certainly, if you look at the Allshare this year, hasn't made much money. If you look at the best performing part of the market, it's the AIM market. The AIM market's up nearly 9% already this year. Now, that might have been driven a little bit by some of the largest companies like Assos and such like, but as you move down the market cap range, you're seeing little companies gapping up all the time, and that's because they're cheap, and there's a growing level of takeovers going on with the bottom end of the market. We talked about the fact that sterling's devalued. It's devalued by between 10 and 15%, depending on which currency you're looking at. And so if you're looking from an overseas point of view, many of the UK companies have an overseas asset base. They have assets and earnings overseas. They have opportunities to invest in the UK economy. And we're beginning to see that from an overseas point of view, not only are you buying companies cheap in the UK because the smaller companies have underperformed the larger companies, but on top of that, you're buying them cheap because small companies have also taken advantage of the fact are quoted in sterling, and if you're buying in dollars or euros, then effectively you're buying cheap as well. And so what we've seen perhaps in the last 6 months, and we're slightly unwelcome in this regard, is we've seen a stream of takeovers. These aren't necessarily all companies we want to get taken over. 1 or 2 were distressed situations, but generally we haven't been in favour of these takeovers because although they may be 30, 40, 50% above the previous share price, we think that many of these companies are actually still worth a lot more than this in the longer term. One example where things have actually worked out in our favour is in a company called Lavenden. Lavenden is a company which is involved in those sort of scissor lifts, those little cherry pickers. They change lights and they do works out and on maintenance of external buildings and such like. And there's a business where the share price got down to 120. It was on a P of 7.5, and the management team felt that a bid at a 50% premium, £2, would be a very good thing for shareholders, and they came and recommended it to us and our many other investors. We weren't actually that inclined to accept. It was a nice price to be offered in the market, but we weren't looking to sell, and so we turned it down and others turned it down. And those people who have followed the Lavenden story in the last 8 weeks or so will remember that the £2 bid has been continuously outbid again and again. We've had a competing series of takeover bids, and the most recent offer is at £2.70. So that management team were willing to recommend a bid 35% below the proper value of their company. There's a lot of value in the market. If we do get sustained growth in the UK economy, then we're well positioned for recovery. But we've got to worry really about the slightly longer term. The UK economy, I think, will do better than people expect. I think the small cap sector will outperform, but that's just short term. We've got a fundamental shift in economic policy coming through, and we don't know how, one of the major things is that many of the things we've got used to for the last 30 years won't be there. Falling bond yields, low long-term plentiful cash from debt. Interest rates may go up in time as well. So we've got to start worrying about all of these issues. And most particularly, one of the things in the book which I highlight, I worry about probably most, is that since 1985, UK and indeed US and other profit margins around the world have doubled. So if you take the average profit margin in most industries since 1985, they're now running at twice that level. There's various technical reasons why that's happened. And going forward, we have to start making plans for the fact that actually margins generally, not just within the supermarket sector, but also many of the other sectors, start to come under pressure. And the question isn't just about which companies to buy the most productive, or just buy companies with very strong, robust balance sheets so they can fund growth and take advantage of the weakness of others. We've also got a plan for the fact that margins, corporate profit margins, may be under pressure going forward. And if that is the case, well, how do we select for those companies? And as I say, productivity is a good way to give you a commercial advantage. You can continue to grow your business, but most particularly to hold on to profit margins when other people are cutting their prices. You really need to deliver not just good service, but outstanding service. So one of the features we've been talking to companies a lot about in the last 12 and 18 months is don't just tell us about how good your service is, tell us how you measure it. Tell us how you know whether you are delivering premium service. Tell us how that levels of service has changed over the last 3 months. Tell us how it's changed over the last 12 months. Tell us how it compares with your competitors. And when you ask this kind of agenda, a lot of companies are not well prepared. This is not the agenda a lot of companies are being asked about. But it certainly helps selectors, investors, to pick between those companies which say they have good service and those which know they've got good service. And we would strongly recommend that those companies which know and measure their service levels and those which are thereby able to resist margin pressure at a time when others are cutting their prices won't just get the opportunity to get a good cash payback on their investments, but actually will continue to generate cash and thereby fund further opportunities should other companies get into trouble. And certainly the kind of things when we meet these companies is actually, we find that actually there's some really outstanding companies out there. But there's also quite a lot of companies which are probably overlooking the risk to margins going forward. And certainly selecting those companies with the best opportunities to stay margins, along with those which are investing for capital, for improving productivity, are the cornerstones of portfolios going forward. And our view is that actually this will be much more favouring active stock selection. It'll be much more favouring a multi-cap approach, big and small companies. But it'll also be favouring those companies, even the large companies, which are able to take advantage of the weakness of others when others suffer a setback. Certainly going forward, we would argue that the Retreat of Globalisation will mark a profound turn in investment trends. And for that reason, the opportunity for clients and direct investors to move ahead of the crowd is very much right now. We think that therefore funds which are well positioned, individual portfolios which are well positioned, may not in fact find it easy to make money because markets may be unsettled, but they will find that the opportunity to add value and make absolute gains relative to an index which doesn't help much could be disproportionately exciting. So in conclusion, the world is in a multi-decade changing point. The last 30 years have led to a conformity of fund management strategies which may be overlooking risk. We think there's a real opportunity for differentiating, moving ahead of the crowd, selecting individual stocks on the criteria of productivity improvement, cash payback, and ultimately dividend growth, which we think therefore will drive investment returns. Thank you very much indeed.